Hello everyone, welcome to our Williams percentage range indicator. A very straightforward indicator today, very easy one, a very short webinar. So that would be good news for anyone that is in a hurry because it's something very straightforward, a single indicator, how you can read it, how you can understand it, and how you can spot any signals that it might present. So we're good to go. Actually, I can see that people keep attending. So as usual, I need to go through the disclaimer warning, and I would really appreciate the quick feedback regarding the audio of this session. So this material is provided as a general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. You can find the full risk disclosure on the website along with any other legal documentation that you might need. So guys, just a quick reminder that this webinar is being recorded. So once we're done, you're going to receive the recording into your inbox. Check the spam and the junk folder. Sometimes you might find it there. This is our email address. Don't forget that we are here to help you with anything you need. Webinars@hfm.com is the email address that you can send a request, a question to us, to the analysis team, okay? Feel free, obviously, to use the question box over here in our GoToWebinar in order to let me know whether you don't understand something or whether you need further explanation. Feel free to stick your question over there. So another technical indicator, something that is well known, even though I'm not sure that is widely used, to be honest, but a momentum indicator similar to RSI. Actually the main benefit out of Williams percentage indicator is the fact that the traders can use it to find entry and exit points for their positions. This is the benefit, the main benefit out of it. Okay, it can help you in order for you to find appropriate entry and exit levels of your position. So it's similar with RSI, similar with commodity channel index. They're also known CCI. So it's another oscillator. So you understand that you can spot out of it the momentum. You can it can clearly give you an overview of the momentum and the energy that there is in the market in any kind of time frame. By the way, you just need to adjust it accordingly. It tends to be best in ranging markets. Okay, so firstly, my bad for not showing you how it looks like. First of all, it looks like that. Here it is. Oversold, overbought, 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 oversold. It's ranging, right? But before we go through it and we see what these levels mean and how they could be interpreted, let's go through a bit of the background, the basics mainly of the Williams percentage. So it was obviously, as I already mentioned, it's a momentum indicator useful for identifying optimal entry and exit points of your positions, and it serves as a momentum indicator. So there is a range similar with RSI and with other indicators. It operates within a range. So from 0 to minus 100. So it has minus values. Okay. So what these values mean? So with 0, guys, okay, with 0, and if the line is it has been it's being above 0, okay, that is that's the overbought condition. 0 is actually the level which represents an overbought market, and minus 100 represents an oversold market. So how is the basics, how traders usually use it is by monitoring the area between 0 to minus 20, the area between minus 80 up to minus 100. So these two areas. So traders will usually take a move above minus 20, right? Because it's a signal of overboughtness. And a move below minus 80 towards minus 100, which suggests that the market is oversold. So as you can see over here, right? You can see that Williams percentage is underneath it's below the price, obviously, like all the other indicators, and you can see where the oversold conditions and the overbought conditions are placed. So let me get back to where we have been. I haven't provided the formula of the William. I don't find that very useful, but you need to be aware that the calculation of Williams percentage is basically by default on a 14 period time frame, like the RSI. So basically, let me write that down just for you to just for your own information. Basically, is the highest high of the last 14 periods minus the most recent close, okay, over the highest high again of the last 14 periods minus the lowest low of the last 14 bit. That's a very, very simple formula. Okay, so either if you are in a daily time frame, even if you are in 1 hour time frame, 1 second time frame, 1 minute time frame, this will be adjusted accordingly. So the highest high of the last 14 minutes minus the most recent close over the highest high of the last 14 minutes minus the lowest low of the last 14 minutes, and so on and so forth. Okay, so other lines that you should be very careful about. Okay, so we just erase all these. So other than the ranges that we have discussed, from 0 to minus 20 and from minus 80 to minus 10, you should also be aware on these particular lines. The center line, which is obviously is the minus 50, which is the mid of the mid area from the Williams percentage indicator. Okay, because any crossing above or below the minus 50 could be an early signal that the prices are trading in the upper or in the lower half of their range. Okay, so any crossing above or below 50 suggests either a continuation to the upside or a continuation to the downside for the hour trend. Okay, so it's not like we have the only signals would be the area from minus 80 to minus 100 and the area from minus 20 to 0. There are some early signals we can, if we can call it that way, which is the crossing in the mid of the Williams percentage range. So yeah, so okay. So just to clarify again, these very basics, but the most important things to be done and to be considered. Okay, we're gonna go through the minus 50 later on. Let's stick to the very basic first, which is the area above minus 20 and the area below minus 80. Okay, so as you can see over here, a very clear example. If your strategy, if your trading strategy, guys, involves buying an asset once it shows that it is oversold, or selling an asset when you have spotted that it has been overbought, then Williams percentage indicator could be percentage range indicator could be useful as well, because as we mentioned, it involves buying an asset once the indicator moves above the minus 80. So you see, it was overbought and it rebounded. So, or it involves selling an asset once the indicator reverses from the overbought condition and cross below minus 20. So this is a selling entry, optimal selling entry, and this is an optimal buying entry. Boom, boom. Okay, so an entry to sell is not when it crosses below minus 20. An optimal entry to sell is when it's overbought and it crosses below the minus 20. That's the short position entry. On the vice versa scenario, an entry will be when it crossed above the minus 80 after it was obviously oversold. Why? Because a trader, okay, if the asset, okay, moved above minus 80, like here, above minus 80, a trader might assume that the price is currently bullish, right? And there will be an upwards rally. So in this case, you could go long and speculate on the price of the underlying continuing to increase. So, or you can consider holding a position until the Williams indicator moved above minus 20, because this is a sign at which is overbought. So that's a nice sign that you can close your existing long position, because if you have taken an entry over here on the crossing above -80, a move crossing above -20, it will be an indication that it has breached an overbought level. So it's a sign that it might not move higher for longer. Then it's not it's running out of steam to the upside. So it would be an indication to exit your existing long position. If you haven't taken any positions on this asset, but you have noticed that that it is overbought and it um, um, has turned below -20, is a sign that you should sell the position. You should open a short position mainly. By the way, in these cases, because I know that you will ask me, but Andrea, you can tell, but Andrea, it crossed above 20, but it continued to the upside for a bit more. Why shall I close the position earlier? Another possible use is to close your long-term entry if you see the Williams indicator moving um, um, uh, if you see this pullback, I mean, crossing above the -20 and starting pulling back, ready to cross below -20. With this way, this is also a sign that you should sell the position to your position to realize a profit. On the other hand, is what we said earlier. You can take a move below -20 towards -100, right? Which is a signal that the market is turning bearish, okay? In this case, you could go short and speculate on the price continuing to fall. So, and the same as the overbought condition, again, in this case, if you're holding a short position, you can close your position once the indicator cross below the -80. So at this point, you could take the oversold signal as a sign to close your short position, and with this way to take your profit. Now, before we go through the 50 point, I would like to highlight something, okay? I would like to highlight, guys, that some things that you need to bear in mind when trading with the Williams indicator. It is very, very important to remember that overbought or oversold signals do not necessarily mean that the market's overall trend is going to reverse. Okay, that's why we mentioned that you can close a position. You can either choose to close a position as soon as it goes above the -20, or you can consider closing position once you see it falling back below -20. Why is that? Because it can stay overbought for a long time, right? Like this example over here, this was an old Cisco example, which it breached overbought early March and it stayed above, was done it was like tumbling between -20 and 0 for more than a month, and with this way it continued to move higher and higher. So a breach of an overbought area is not necessarily, it means that the market's overall trend is going to reverse to the downside. Instead, an overbought signal could simply mean that the asset price is near the highs of its previous range. The same stands for the oversold signal. And an oversold signal could mean that it is near its previous lows. Okay? That's why many traders use as an exit point the crossing below the -20. Okay, in order, if it's overbought and stays overbought for longer, in order to add to their existing long position and benefit even more. So here as well, you see, overbought. So a lot of consolidation followed. It managed to extend, didn't manage though to breach the -20 and extended lower and went back to the oversold condition. So we could see a continuation of the downtrend. You can tell me, but Andrea, I will have probably exit. Yeah, that's the reasonable thing to do. It's all about risk management after all, right? But you could indeed close your position and save with this way, lock some profits. And you could, if you had another sign of a continuation of this downtrend, such as this sign over here and the return and the move downwards again, then you could open an additional short position in order to benefit on this continuation to the downside. Okay, so you can add you can open additional positions. Let's go back. As we mentioned, now let's get back to the -50 the criteria, requirements, whatever you want to call it. But there is also a different approach, which you can, other than the obvious, the basics, the oversold and overbought conditions, you can also use for your signals, either to add to the existing position or to close a position. You can also use the midline, the center line, the -50 line, because as we said, if the price cross above the -50, that suggests the prices are in the upper range. If it cross below the -50, that indicates the prices are in the lower range. So let's see another approach. Here we are. So with red, we have pointed out all the situation in which the asset was overbought and then it crossed below 50. Okay, so overbought, pull back, cross below 50. This is a sign of a bearish market. And with green, we have all the situations in which it used to be oversold. It crossed above -80 and crossed at the midline as well. Okay, so why these are also important? Because if you have missed the -20 situation, the -20 move for a short position, okay, you could also enter here when it crossed below -50. Or if you haven't missed it, if you haven't missed it and you have already a position open, a short position open, once you see a move below 50, you can add to that position, because the cross below 50 means that is a very strong downtrend and there is a strong momentum still to the downside. Okay, so minus 50 could be useful for opening a position in case you have missed the beginning of the trend, or to add to your existing position. Where is it? Okay. The same stands for the exact opposite scenario. So here, because okay, obviously you cannot blindly follow the indicator, right? You are watching also your price. If your price and your indicator are not in line, you cannot take a final decision, right? So like here, the indicator was overbought, right? But here we could see a bit of a consolidation at the bottom of this range. So that wasn't clear whether it will continue to the downside or whether it will rebound. So it became clearer once we had a coordinated move of the indicator above minus 80 towards minus 50 until it crossed it, coordinated with the price which gap up outside this range, above this range, over here, and closed over here. So that was a coordinated move that now we are in a bullish trend, a strong bullish trend. So a nice entry point will have been this level over here, because we had also the confirmation from the indicator, and we had the break of the range of the 1, 2, 3, 4, 5, 6 days range, and the closure above it. Okay, so let's see a false alarm somewhere. Let me check. Not a false alarm, actually. For example, here, right? Overbought, right? Overbought. It's overbought, indeed, overbought. And until it finally crossed it over here, but when it crossed below minus 20 over here, it wasn't enough, okay? Because we see that the next day it came higher again, and the very next day also it remained higher. So okay, obviously you could enter here as well, but there was still, it wasn't a good decision, because the following day the bulls took the control again. So it was if you had taken that position over there, it might was a bit in a hurry, because if you check this candle as well, it has a long tail higher, indicating that bulls are still trying to defend this asset. So the next 2 days it sustain its gains, right? But the third day it crossed below. You cannot really see it because there is this red lines on. Erase all. Nice. Come on. Basically, guys, in this candle, right? We could see that it retested this area over here, but it didn't manage to break it, and it break it the next day with this candle over here. So that was a nice entry level, okay? Because we had a confirmed move of the Williams below -50, and we had a breakout of the latest floor seen in our price action. Okay, that is also an evening star formation, so we could indeed have could enter earlier. So, but again, it's, both entries were just great. Okay, so it came down, tried to recover it, right? So you could close some profits over here or close all of your position. That's fine, don't worry about it. But you could take another short position on this pullback over here. It retested the -50 and turned on the backwards again. Okay, so there was an indication that there is a continuation to the downside until indeed it stopped extending lower and lower and lower. We have double bottom of it here on the indicator, indicating that there might not be any further steam to the downside, anything below that area. So there was some consolidation followed over here. You see the double bottom over here until it crossed above -80 here, somewhere here. In which you could open a long position. But again, in case of any delay and etc., there is still either this buying the dip situation over here, or you can use trend lines on your indicators and benefit from some short-lived positions. So if you missed that, or for any reason you decided not to take an entry, if you missed these, the cross above -50, then by connecting the latest highs, you can enter as soon as it cross above the previous two highs, but benefit just in a small move, which is just fine as well. So this is the way that you can use the middle line, either to add on an existing position or to open a new position if indeed is in line with what you can see in your actual chart and in your actual trend. You're seeing a continuation. You can see a continuation to the downside. So here, cross below 50, boom, down, sideways. So it looks like a pennant or a flag. Down along with the coordinated move below -50, which is calling for a short position, right? Easy busy. Basically, you can rely on what you see on your charts, like a flag, a rounding bottom, a range that it needs to be broken, a flag. And if you notice a pattern, a candlestick pattern such as the ones that I mentioned, you can check your Williams and see whether it's pointing out, signaling on the same direction as the breakout of your candlestick pattern, so you can get a confirmation from the Williams indicator. Like here, it was in a range sideways, broken the range, coordinated move with a move below -50 in the Williams indicator, so another short position, entry for a short position, right? An exit level, an appropriate exit level, as soon as it turns, it turns either as soon as it posts a wick over here, or as soon as it cross above the minus 80. You can close your position at that level. Here, you see a channel and down channel with the William RSI nicely. Sorry, I need to draw that better because it's very important. Okay, not ideal, but you get the point. Channel, and if you connect the highs in the William indicator, you can see that in this we have lower highs in the Williams indicator as well that are in line with the downwards channel of our price. So a cross of the price outside the channel along with the cross of Williams indicator above our trend line is a confirmation that we have a new trend, and in this case it was the beginning of an uptrend. Okay, another way, higher highs, higher lows and higher lows in line with higher lows in our price action. Another indication that we are in a bullish market and we should join the trend. Trend is your friend. Another indication. Sorry. Here we are. After it crossed, it broke in the downwards channel. It continuously posted higher highs. It also crossed. This is looks like an ascending triangle, and it moved above it. So you can see that there were a lot of signals in this particular example. Okay, and another one. So this is another one in which you can take into consideration the value of the William indicator. Okay, so basically, you can see over here the value was something like very close to 0 over here, but over here it was -9, a very small like triangle, indicating that we are done. We are nearly ready to pull back for a pullback. Okay, very narrow, another narrow over here, but that one, it was the very first sign that the existing uptrend is running out of steam. So this kind of signs, squeezed, very small area, wicks, let's say, how can I say, triangles above the -20, these are indication after such a big area over here. These are big areas, right? Such a tiny triangles indicate that there is not a lot of bulls in the market and something is changing, the sentiment is changing. That was a very prime indication for a pullback. Okay, so things like that should trigger your attention because the indication that we are nearly done. The same stands for the exact opposite scenario. If the close is lower, so you see, you can see it from the lows, you can see it from the highs. So that was the highest level of the overbought condition, -87, indicating that the sellers are losing the control and that bulls are taking over, trying to push the indicator higher. So in this case, a nice entry point will have been this crossing over here above the latest swing high. another, that one. Okay, closing some profits over here, closing the long entry, opening a short entry over here that it will last for a few sessions only, and so on and so forth. Okay. So that was pretty much it, guys. It's a very straightforward webinar, very simple, a very simple indicator. George, I'm sorry for that, but we're not we no longer offer the PDFs according to compliance. It is prohibited. But we keep providing our recordings, so you have the recordings, you can go through them, pause, take notes, resume them again. But unfortunately, due to the advisory service, we can no longer provide PDF files. Okay, that was an hour call. Unfortunately, we shouldn't provide any of our presentation in a PDF format, only demonstration via the recording. Okay, I'm really sorry for that. So don't worry about the link. You're gonna get the recording straight to your inbox. But once I'm done, once I close the session, you need to wait a bit. It needs 15 to 20 minutes maximum. In 20 minutes, if you click again the same link that you attended this webinar, you're gonna see the recording. So there are two ways. Either wait for our YouTube link, which will be sent in your email. Okay, always check the junk and spam folders, or wait for the next 20 minutes and click on the link, on the same link that you have used to attend this webinar, and you will get the recording. Okay, so guys, I can see that there are no further questions. I'm gonna call it at 8. Obviously, anything you need, send me an email at webinars@fhfm.com. Even if it's not about the webinar, okay? If you're struggling with your strategy, you think that you're doing something wrong, take screenshots of your platform, take screenshots of your position, and we will try to find out what went wrong, what you need to amend. Okay, we'll try to do our best and help you. Thank you very much. Have a great day ahead, and we're gonna see you actually later on this week with another live streaming in social media and etc. Thank you, everyone. Thank you. Bye-bye.